We had tickets at $200 million at the time. We can operate fast, we can adapt, we can pivot. Lovable is a really good example of that. It was more of a smart trick for creating liquidity.
From Revolut to Stripe to Deal, and the list goes on.
People need liquidity. Spending close to $1 billion for acquiring an investment firm,
it's maybe the easiest period to get funding when you use AI as your tagline.
Because the market is so fragmented that you can be this opportunistic.
The typical regional discrimination.
Can the valuations be sustained? I'm not so sure. You will never go 100% AI.
As of now, it's not perfect, let's be honest.
Now what we need is to scale that. Who are the people that are building the product that I'm using?
Full disclosure, you have given me the green light. Here we are, second episode of VentureTales, and so we have the honor to have with us Daniel from Rebloom. Welcome, Daniel. It's a pleasure to have you here. Before we start, it's always great to have an intro and to talk a bit about yourself, and then we can get into more details about your company and your mission.
Yes, absolutely. And thank you so much for having me here, Alex. I've been looking forward to our talk. So to give a brief intro on myself, I'm Daniel, the CTO and co-founder of Rebloom, and actually come with a quite different background considering that I'm in private market finance right now. But I have a background as an astrophysicist. I've been working a lot with data science, machine learning, and applied AI, but within science. Mm-hmm. I also went to Switzerland. I worked at CERN, where it was also applied in data science within particle physics. And that's then when I changed directions kind of, because I moved back to Copenhagen and started venture capital firm. Actually, I helped start it. We were only 3 people and we set it up from the beginning. And this was an early stage deep tech fund. I could kind of put on my nerdy aspirations coming from a background in physics and just get to do a lot of exciting and fun stuff. But it was also an entry into the startup scene because we were only 3 people at that point. So it was like being a startup founder as well. So ironically, investing in early stage startups while being one. Naturally here, I also leveraged my technical background to start building a lot of cool AI applications for venture capital and like financial markets in general. That turned into a spin out where I then was the head of AI. And then that was basically my entry going from data science and within the domains of astrophysics into private markets. And that's also where I encountered secondaries as an asset, which was quite niche, especially in the Nordics where we started, but it's the space that we're in now that's really taking off, and that's what we're doing with Rebloom.
It's a very unique background. I have heard also some other stories, people starting from the hospitality business and other realms, but your story has quite a twist, going from an astrophysicist into secondaries. I saw that you're also part of an immigrant family, me as well. So I'm curious if this has affected, how in general you see business and life, and if you have some unique, let's say, mindset around it, or just because you were the second generation, maybe it doesn't affect you that much.
Oh, you've been doing your due diligence. Good work. Yeah, no, but that's true. So actually, I'm born and raised in Denmark, but I have 0 Danish genetics. So I'm actually half Polish and half Kurdish. And then I was born and raised in Denmark in the rural parts, like completely up north in a small fisherman's village. So there was something completely different than what I'm doing now. And I guess this is like taking on the long lenses and kind of the helicopter perspective on this. All of the opportunities that I've been given and has a lot to do with this social mobility that's possible due to the governmental infrastructure we also have in Denmark. So yeah, we might have high taxes, but it's what allowed me to come basically from nothing, having no network, nothing at all, going into astrophysics, also moving to Copenhagen, doing education, even getting like a alimony for taking education as we do here in Copenhagen, which is wild when we compare with the rest. So it's really given me the opportunity to pursue my dreams unaffected by my social background, basically. So yes, it's given me a lot of, what I would say, first of all, a lot of respect for my parents and what they had to go through, because naturally growing up, you take things for granted. But I think especially in terms of this sector that I went into, it's a bit different because it's kind of like a opposite, right? Going into private markets, going into venture capital, etc. It's where a lot of money is present. And there's a lot of legacy there as well, saying that it's something that might have stayed in the family, and there's some gatekeeping, even how to even enter these markets, etc. So in that regards, I guess it strengthened me in the way that I come with a different perspective. And I guess I don't take all of those social hierarchies too serious. I'm more just a tech nerd that went into this field because I like to build cool stuff. So I guess it's helped me in kind of arranging that perspective in the way that we operate, and also being a startup founder and the way that we kind of do leadership and build a social setting within the company.
You're quite a young founder. So, what are some challenges that you have faced, especially initially? Because, to be honest, you're operating in a very regulated, compliance heavy environment. And I assume you had to tackle some challenges straight ahead in order to, ensure that your future actions face less friction.
Absolutely. But the interesting point is that being a young startup actually gives us the opportunities that the big capital heavy established institutions don't. Because if first of all, you're established and you have all your legacy systems in work, and that's what we've been working with for decades, it doesn't give much flexibility to kind of change that infrastructure. You're kind of locked into that and can only do tiny adaptations. And because you have so much compliance, you have to be so careful with each action and decision, the decision making becomes extremely slow. While as a startup, it's a learning experience, and we don't have everything from day one, but instead we have the sheer power of execution where we can operate fast, we can adapt, we can pivot, we can arrange. Because when we went into the market to begin with, we had our experiences from venture capital with secondaries, how many problems there were with it there. Also just the educational aspect of it, that a lot of people in the Nordics didn't know it. It was more of a smart trick for creating liquidity, while in the US and the rest of the world, it was becoming more key asset for creating liquidity, and it was already more mature. But for us, it allowed us to disrupt a legacy business by doing it completely different, leveraging the newest adaptations within applied AI technology. Honestly, we're just being experimental. We're building stuff, and that which works is applied. And when it works and it hits the spot, it's what really creates or unlocks liquidity for.
Yeah, and I think you also had great timing. I don't think, to be honest, it was a luck, because I've seen from 2023 to 2024, secondaries doubled. So I think you went there with pure knowledge of the market trends, and you started to Rebloom. I wanted to ask you, your customers are mostly or only institutions? So you deal with any retail investors, right?
So it actually developed. So we went into market 10 months ago with a freemium model where we were mainly targeting private investors and early stage. So not retail segment, but angel investors, smaller funds, boutique vendors, etc. So
A more educated audience.
yeah, even those people also have a hard time gaining access to the secondaries market, which is why that was the first step that we did. We lowered the entry barriers there. But as time progressed, 90% of the client is institutional players within secondaries. And as you mentioned, the timings, this is just the perfect storm, because the technology was there in terms of doing the applied AI tools, and the timing was there with fewer and fewer companies going for an IPO, they stay private for longer. The geopolitical situation also means that there's a lot of uncertainty involved, and secondaries just become extremely important for the money flows and for creating liquidity, and people need liquidity. So it is just a perfect storm where the market is accelerating so quickly. We are no entrant, and it was a niche market, so people are waking up to it now, and we already built something and we are expanding on that.
Touching back to what you mentioned about you as a company, being agile, not having, the rigid process that a more enterprise level company has, and how this affects secondaries. So I want to ask you, we see lately so many companies do secondaries. We've seen, from Revolut to Stripe to Deal, etc., the list goes on. Do you think that the main reason is to preserve what you mentioned? So they want to remain agile. They don't want to deal with the compliance and documentation of being public? Or is there maybe some other reason in your opinion?
Yeah, so first of all, there's that the hurdle of all the regulatory and compliance. Once you actually allow retailers to invest in your company, it becomes a completely different game, also in terms of regulation, but it also in terms of governance, that staying private for longer means you have more control of the decisions and your company as you go. So from a point of view of the companies, it makes sense that they can operate with more agility, even at that level, the pre-IPO.
Yeah, and you can experiment, right? Because right now, for example, let's take Revolut, for example, because they are all over the headlines. We know that they operate in a way that is testing quickly. Some projects work, some projects don't work. But if you're public, one wrong quarter can dip your price like 10%. So I think that is also a consideration.
Exactly. And just think of that. They just made an announcement now that they got the MiCA regulation for doing crypto assets on their platform. And that is such a, or you say, it's a hot topic, and but it can also be a bit triggering for some people to say that you did that while you were a public market. Some people would even say that it would be irrational kind of reactions that the market would have to that. It would create a lot of volatility in the price. While if you keep it private, it's already decided within the company, within the current investors, and you can do all of the strategizing, and you can kind of take that decision holistically.
I saw last week some news which were pretty interesting to me. Goldman Sachs bought for almost $1 billion industrial ventures, and their main reasoning is to get into the secondary market. So going back to the legacy companies, do you think that this is a solution that can give them an edge, or they're just trying their best to get into the market with any way possible?
It's a good question, because we can say that if you're within private equity, of course, you know of secondaries as an asset, it's being used there. But because it's also so much in its early days in terms of its expansion right now, it's going back to the fact that we talked about, that if you're already completely established and have that infrastructure, moving into the secondaries market can be done very slowly. It will be slow decision making, building all of that, getting all the higher ups to agree to such a strategy, which means that you're already missing out on an explosive market. And also spending close to $1 billion for acquiring what's basically an investment firm,
To buy
it
the
sends a
network,
signal.
basically.
Yes, but it also sends the signal what they're trying to do. They want to acquire an infrastructure that's there and then integrate it into their own. And when a key player like Goldman Sachs does this, I think it also sends ripples out in the rest of the market, telling the other large asset managers that this is the name of the game now.
So you predict maybe a M&A spree in the following like 2-3 years?
I could see it happen, because if you compare, and that's what's so interesting about it, because the market that we are within are enormous institutional asset managers. So they already have the capital. I mean, you see it in sectors like right now, there's a lot of hype going into AI. So there's a lot of money in AI, which allows a lot of AI companies to go into this acquisition base now, because it's a hot, trendy
Yeah,
sector
get the
for now.
premium.
Yeah, yeah, exactly. Lots of premiums there. But while when you enter the asset management market, that's always been it. Like,
Let's switch a bit the topic now. I'm interested in your go-to market and sales. So I understand that you don't have like a huge marketing budget. The way I actually found you is through LinkedIn, because you and your co-founder are very active. I don't know if I can say building in public. I would say it personally, but I want to hear your thoughts on how important is it today to build in public, to get the inbounds, to get the exposure, especially if you are operating in a lean way like you are.
yes, interesting point, because I don't have any marketing experience at all. I'm not a marketing person, and I'm definitely not an influencer or a content creator in that regard. Our marketing spend is almost non-existent. So we have a CMO as well that helps us in terms of like the direction we want to go in terms of how we are presenting ourselves. But as you also mentioned, what we're doing is very much going into the era now where a company seems very, if you have a company page and you're just generating content and putting it out there with the face of your company logo, etc., it seems very distant. And that's how you've been doing it for a long time. It's a brand, you recognize the logo, and that's kind of the thing that you're recognizing. Where now, especially in the startup scene, what's worked for us is that all right, we have a nice logo. We know that, but you want to see the people behind. Who are the people that are building the product that I'm using? And if you become recognized in that term, it creates a layer of trust as well. And honestly, it's not just a growth hack that we're doing. It's part of the journey. We want to share this being founders and also sharing the ups and downs in a way, because honestly, it's not like everything is set in stone. There's a lot of surprises. There's a lot of learnings. There's a lot of things that go wrong, but being able to share that journey also creates a good story for the users that finally meet us. And it's working because, as you say, LinkedIn has actually worked really, really well for getting inbound leads. So in a market like this, getting the foot inside, cold outreaches don't get you long. But if you have a brand where you're basically shoving it in their face, we're doing this, and then they come to you, it has worked tremendously well for our business model.
We have seen this shift in the last few years where it was important only for consumer companies to connect, let's say, with their clients, but now it's really a must also for B2B, especially with LinkedIn. So I guess this is how you found your first customers and listings. Has it evolved since then? So do you do some actual active outbound, or is everything that is coming to you?
So in the beginning, this sourced into the startup journey. We had ideas of how this would go. All right, we're a Nordic company. We know that what we want to do is be global because the secondary market is global. That's where the activity is. So we thought, all right, we'll start in the Nordics. We'll start in Denmark. We'll start with angel investors, more private segment, kind of get them on the platform because it's at that point it's free. You get access to the market. You can find a nice, good listings. So we had to actively also go out with our friends and family, of course, to test out the platform. And then luckily, because all four founders, we have backgrounds in private and public markets. So we also have a network coming from VC. So that helped us a lot as well to being connected on the small scene. But still, it wasn't quite the mode for what we wanted to do, because the ticket size that are interesting for us are much larger. Then it became interesting because we thought, okay, start in Denmark, then we go into the Nordics, then Europe, and then as soon as possible after we want to go to US and Asia. But what happened was that we got the initial users in the Nordics. We started this LinkedIn content generation. And because we went into such a niche segment like secondaries, the algorithm picked it up that everyone that saw it were people dealing with secondaries, which is a niche, which suddenly was global, which suddenly was institutional asset managers within this space. And from then, it just took off. And so it has really rewarded us a lot in that regard. And that's also why we now cater much more to the institutional segment within the private market secondaries, because we got them in and those became our target clients. And from then on, it's just been a self-growing mechanism because you get more institutionals, you get more exposure and the way through.
Full disclosure, you have given me the green light. So let's see. I want to understand how the business makes money. So is it per transaction? Is it access to the platform? How are you structuring, your cash flow?
Our model is, this was also a struggle in the beginning because this was one of the tough questions that we had to find out, because
Yeah.
the market that we were in is a lot of independent brokers where you have buyers and sellers and everyone kind of gatekeeping and saying, oh, I know someone who knows a buyer for your position. And then,
Yeah.
but I'm not going to tell you who I know before I get 2%. And then the next guy that I introduced to wants 2% as well. And then they have the seller, and then it goes through a lot of
Yeah,
layers.
everyone
So
is taking their piece.
they are, and that's exactly why this market needs disruption and some infrastructure, because they are being, the reason this is possible is because the market is so fragmented that you can be this opportunistic. That's what we're kind of changing. So we went out with a completely free version of the platform, and it's still free to sign up and use. We have both a public, which where you're still fully anonymized on both ends, but we have a public version of the platform where you can go in and find listings and find buyers. But we also have the dark pool, which is really catered to the institutionals, where we have these really large ticket sizes. So coming back to how we make money, the platform is free to use. You can use it for scouting, for sourcing, for also for getting help in this space, because we build a lot of also industry first AI tools for due diligence, such as so we have AI driven waterfall simulation models for checking the share class hierarchies, because there's complexities involved in secondaries, and for AI deep research agents for market reports, etc. All of this is free. we make money by taking a incredibly uh, incredibly competitive transaction called unsuccessful transactions. And this was also one of our motivations, that the platforms we used back when we were in VC, it was opaque and it was incredibly high transaction fees, which were only possible because it was so fragmented. And then we thought, okay, we can build something where we can really create liquidity at scale, which allows us to take a much, much, much lower transaction cut. And that is the parallel to what you saw in public markets, right? You've seen Wolf of Wall Street, where when you had to broker deals, it was by phone, by email, people yelling high energy, and it was whole percentages of a transaction when doing that. But then you went into getting these order books and it all became digitized, and you had the technology, algorithms, stock pools, etc. on the public markets. And now you're doing like 0.05% at some transactions, and you basically cut the transaction cuts by many magnitudes. And that's the transition that we are also trying to do for the private market now by enabling.
Just to get a better understanding, you are acting mostly as a marketplace, or are you handling and supporting also with the actual, due diligence, transactions, etc.? So are you purely a discovery platform, or you do also support all the rest?
So we carry end to end on our platform, but we had to start at a place when we were still very early as a startup. What we did was, it was a marketplace for discovery. So matching buyers and sellers on the platform using AI for algorithmic matching between them as well. And was more about them being able to find each other and easily get access to this market.
So you
instantly
tested the
on
market
secondary.
with a MVP basically, and once it's worked, you were able to expand.
Exactly. And then we went into the next step, which was the sub process, which was the due diligence aspect, where I really got to shine with all the AI tools that I could build on processing and financial models, etc. So that's where we were catering to more serious players and the things that they need to do a secondary transaction. And then the final step is building this infrastructure with the order book where you can cover end-to-end transactions on the.
You're based in Denmark. Are your customers or your accounts mostly European, or are you also looking for US based or even Asia based institutions? Do you have any specific targets, or the world is open?
The world is open, but we very quickly saw that the majority of the institutional players are from US, and we also have some from Asia, and then a lot from the UK as well. So it's really arbitrary that we are in Copenhagen. It's because it's where we live, but our operations are mostly global.
And what about operating in Denmark as a startup? Is it, in your experience so far, I understand it's been a year, but as of now, do you think it's a place where it encourages startups? Maybe regulation should have some changes, or what is your general impression so far of the environment and fostering, startups?
It's a loaded question because
So many
it
things
can
you can
be
address.
yes, and it can be answered from two perspectives. It can be answered from the point where you have to take the risk of even starting as a startup founder. And then you have it once you make it to a certain success level where how that continued growth is then
The
stunted.
scale part, yeah.
Yes, and I can mostly talk about why it's really good in the beginning, because imagine this, you even if you don't have savings, you have large savings or anything. In Denmark, the social security net means that even if it fails, it's not like you're gonna go homeless. It's not like you're not gonna be able to have food on the table. You will have a social security net that kind of enables you to look for a regular job, but at the same time also support you in trying to go the startup way or become an
Yeah.
entrepreneur. And we also have these programs that is a bit more. So that's the thing, right? For example, at my university, there's a lot of encouragement for trying out becoming an entrepreneur as well, and even the unions that you have also can make these programs that support you in jumping out as a startup founder. The only issue is that the climate in Denmark for startups, it's a different breed because it's more conservative. It's smaller investments. We call it also the Danish mindset, where wait, don't dream too big. Get those
Yeah.
valuations down, and
The typical regional discrimination.
kind of, yeah. And that's the thing why it's very difficult to then compete with markets where the venture landscape just understands it better. They understand what kind of money is needed to actually scale exponentially and how to incentivize these founders. But at the same time, say in the US, you have to use your life savings to even attempt at doing a startup. If it fails, if you suddenly get injured or sick and have to go to the hospital, the risks are catastrophic for the consequences of doing so. While in Denmark, I'm really happy, again, speaking back to the fact that we have a lot of opportunity due to the good social security that we have here.
That's great because it gives the first initial steps with some safety so you can take risk. But yeah, when you go to the scaling phase, then you need to evaluate how to proceed. So you have taken pre-seed investment. Is it purely from Europe or do you have also US investors?
It was the Nordics for our first round.
And my understanding is that you're now going for a seed round, so you're in the process.
That's true.
What are some things that you look for in an investor apart from the money, which is the obvious, of course? But right now, what is the expertise that you would like to receive from those people or those firms? Is it network? Is it support with recruitment, advisory, or anything else that comes to your mind?
At this point, of course, opening doors is extremely valuable in the field that we are in, because before it was more about having capital to do our operations and please don't interfere too much with it, because at that point we had to prove that the vision that we have is that what is actually needed in the market. Now that we have the proof of concept, the proof of business, we're generating revenue. Now what we need is to scale that. And that requires people that also know the name of the game, because this is not retailers transacting at thousands of dollars. We are talking ticket sizes of sometimes above $100 million at a time. We've had tickets at $200 million at a time, where it's just a completely different game when you cater to these kind of institutions and what kind of mechanisms go into this, both on brokering aspects, but also regional. And also it's very connected, because once you're up in those scales, a certain element is also knowing the right people, because there's a lot of trust that's needed in this kind of market as well. So we're looking for both strategic advisors that can open doors, that know the private markets, have also seen this evolution and where secondaries are going, because it's still, we need to acknowledge it. It is a niche segment, so you need some expertise on that field as well.
I would say that right now it's maybe the easiest period to get funding when you use AI as your tagline, but you are a specific case. So you operate in a specific niche that you want also all the things you mentioned, the network, right knowledge. So I guess your journey to the seed round will be a bit more complicated than just asking something for AI. But
Yes.
yeah.
And also we're doing a kind of different model, which are the kind of next gen startups, where it's kind of like the Lovable Model, where teams stay lean for longer because you have all of these tools available. So it doesn't mean that, all right, now we're going to get a seed fund raise. Now we're going to get a lot of money. And now we're just going to expand aggressively on team size, as what's the usual playbook at some point for scalability. Now it's more about, we want to scale the amount of revenue we can do per headcount while still staying a lean team. And Lovable is a really good example of that.
We cannot have a podcast without mentioning AI. So I have mentioned this with my previous guests as well, that it is clear that it's not a bubble from an operational perspective. But what are your thoughts when it comes to the funding inflation that we see? In my opinion, it's a bit, typical VC that trying to get into everything to get the 2-3%. But what is your opinion? So do we live in an inflationary AI funding period?
Well, I mean, if I look at my LinkedIn, everything that's going on right now is AI. And also, if you're looking at the conversations being had within the investor communities, it's like, okay, it sounds cool, but does it have AI? Of course, naturally, when you have a big tech advance, it's gonna drive a lot of hype that goes into that. What I'm thinking is, a lot of funding is going into the market. Can the valuations be sustained? I'm not so sure on everything. When we see some of these companies who are almost within a year a unicorn, there haven't been enough time to prove it yet. It becomes more of a arms race, I will almost say, because it's about these small advancements and suddenly wipe out a competitor. It didn't take Anthropic that long to catch up to OpenAI, for example, in terms of quality of the large language model. And at the same time, you have the whole open source community that is not even that far behind. I mean, it's it's such an interesting mess right now with that landscape. But naturally, more money is flowing into that than different sectors right now because the hype is real. Of course, there's a lot of revolutionizing that's going on with AI, and we'll see more of it. It's here to stay. But the amount of AI companies that pop up, that's a temporary thing. We're going to see, I believe that we're going to see a large cutoff in companies that might more be AI wrappers, and then we're gonna have select few industry leaders that are gonna stay there.
Something that I want to ask every first-time founder that I have on: how did it feel when you got this first client?
We got the first client.
Yeah, when you saw this first deal coming through and the first revenue hitting the bank.
It was like, honestly, it was also a bit of relief because from day one, we knew what we were heading against. There was constant adaptations. And when it finally came through, it was a lot of joy, but it was also finally now proof of concept. Now we're doing it. Now we have a story. Now we just have to continue because in this market, it's being a new player is really difficult. You need to prove that you can do these transactions, and then you truly unlock the scalability from there. So it was a great feeling, but it was also a kind of, okay, now the pressure is on because now we need to scale it.
Now it got real, yeah.
Yeah.
Right now, what is your main priority? What is your main challenge? What is something that you're actively now as a company trying to resolve? Based on my understanding, looking for funding, probably this might be one of the priorities. But from an operational standpoint, what is your number one fix right now? What do you need to address?
It is definitely in terms of creating this infrastructure that's supposed to support our whole business model, because that's the thing. Like, unlike our competitors, we are not a large team of brokers. What we're doing instead is building this technology there. And we build a lot of it that helps in these processes, but it's also about finding the mode, right? Because now we have the technology in place, but a lot of it was also which part of these are actually necessary for the revenue generating aspects of it, because a lot of it is focused on, yes, these due diligence aspects, but you also have these large institutions who have their own back offices. They're not going to use our waterfall simulation models, or they're not going to use our document processing or virtual data rooms per se, while others might do. So now it's about truly integrating everything together and making it intelligent. It's being learned by breaking stuff as well, because we're closing deals, we have our experiences and learnings from this, and this is still ongoing. And now embedding that into our technology as well. It's a lot of learnings because sometimes you have to kill off some features. Sometimes, you have to do small tweaks. So right now it's about finding that perfect balance, especially in the balance between how much human intervention and how much automation from AI, because you will never go 100% AI in terms like this. At these large transaction sizes, it doesn't make sense. You need a human in the loop. There's a trust layer, there's some communication still, but it's about finding that sweet spot that truly makes our model scalable in terms of transaction volume.
Yeah, you need also to mitigate the risk. So yeah, AI is great, but as of now, it's not perfect. Let's be honest. Having the layer that you mentioned is for sure something very helpful. Once you onboard someone, as you mentioned, we're talking about institutions, most of them running on legacy systems. How easy is it to actually educate them on the platform, explain to them, the benefits? Is it as challenging as I would imagine, or is it easier?
Luckily, these players, because they also have a lot of interest in secondaries, they've also tried what's out there. So they've tried other platforms as well. What they didn't appreciate there was the lack of transparency and the lack of insight into what's actually going on. And finally, also the fees that are being taken for a service that sometimes is nothing more than an introduction. In our sense, what we've actually felt from the institutional side, which is very nice, it's when your work is being appreciated, because we are building, or have built as well, really complex tools for due diligence as well, like liquidity distributions with liquidity preferences, going to waterfall simulations. It's not a simple tool. It's something that back offices use for institutions, and these virtual data rooms with document analysis as well. There's a lot of complexities in these shareholders agreements as well. It's nice to get the reality set from them that they actually know that where these tools are being applied, where they're necessary, and it creates a kind of a symbiotic link because first of all, it's something that they can use, but it also creates a layer of trust that is like, you know what you're talking about. You're not just selling me a share in space. You actually know how it functions in a specific kind of structure and how it works with different asset classes and what a hurdle rate is and basically what this asset actually means for me as a buyer or seller.
Actually, now with the topic of knowledge and having an educated customer base, it came to my mind maybe a future business opportunity for you to actually utilize also the large amount of data that you're going to gather going forward. So the more trends you see in secondaries and the more deal flows you see, it could be a good support service to provide also some data for them, since you can crunch it pretty easily, I can assume.
It is once you have that data, and that's what some people have like a business model only doing that, specifically trying to find the different price points. And it's interesting, right? Because that's one of the big enemies of the companies is all of these fluctuating price points on their company that are out there in public, and companies hate it. So going back to the secondaries market, it's not uncommon that you hear about, for example, with Rebel blocking secondary trades, blocking these transactions, because there's a lot of friction involved from the company side because they might be raising a new round. They don't want you to go out and okay, apparently someone is selling at a 50% discount or someone is selling at a premium, but they don't disclose the ticket sizes. So people have no idea if you're selling a big allocation at such a price because that will hurt the funding round, etc. It's like the Wild West where prices are just flying everywhere. We're ensuring that these prices stay confidential. And in the end, the vision will also be to have this data set, but also invite the companies in to actually say your biggest issue with the secondary market is how wild west it is and unstructured it is. We can present to you in a confidential and private way insight into what's actually going on in the market with regards or with respect to your specific company. And I think that has a lot of value as well.
I'm curious, based on the deal flows that you have, do you see mostly deals being driven from LPs, or do you don't have any visibility on that?
We do. I will say that employee startups are the ones that you might hear more about, but it's not really representative of where the largest floats are. We see it much in GP-led and LP-led transactions where for some, it's a private market. So for some, secondaries can be their entryway into the cap table for later investments. And that's why it makes sense for secondaries to strategically invest to be able to follow on the primary round that comes afterwards, because now you're into. So it is much in the institutional segment that we see this, but it is also for early investors who don't have a 12-year horizon before an IPO. They came in early. They've been on the company cap table for 6 years. They need liquidity now. They want to sell out of their assets.
Great. So thank you very much, Daniel, for joining. I hope we're going to speak again soon, maybe after your seed run has been completed. Fingers crossed. And I would be happy also maybe to talk to your co-founder at some point in the future.
Yeah, absolutely. We'll schedule something. It was a real pleasure, Alex. Thank you so much for having me.